Hello traders, welcome to Liquidity Narrative Classroom. So in today's classroom, we want to look at the chart and carry out the practical teaching aspect of this particular topic. And I will ask you this, have you ever noticed maybe like when you're trading or sometimes you see price chopping side by side, just like price is doing here. If you move around your chart, you can see price maybe moving side by side, not giving a clear movement or something of that nature. You can see them in your chart in different time zone. It doesn't matter the time zone you are, it doesn't matter the time frame, sorry, you're looking at. You see price moving side by side. It can be hours, it can be some minutes, can be days. They just keep moving side by side. And other times price suddenly shoot up or shoot down so fast, just like you can see. And then you're wondering what's going on in the market. So today I'm going to explain the difference between the consolidation and displacement and how institutions actually move price. That's what we are talking about today, looking at consolidation, looking at displacement, how institutions move price with this. You might actually ask yourself the question, what does that got to do with you trading or maybe making your trade better? If you listen, pay attention to the end, you understand how this will help your trading, understanding consolidation, understanding displacement. It will help you to know exactly how institutions move price. These things, everything that happens in charts are needed. If you understand them bit by bit, it will you put them together to help your trading. Like we often said, the channel is not for signal giving. It's truly a place you can learn to fish for yourself and not waiting for someone to give you fish when they are able to. So the question now is, what actually is consolidation? What do you understand to be consolidation? It can happen, like we said, in few minutes, few seconds, depending on the time frame you're trading, hours, or the time frame you are looking at. As we are seeing on this particular chart, we can see a lot of them happening, price moving side by side, chopping. So we actually say consolidation is when price moves sideways in a tight range. You can set this price moving to this, come down, move to this, not giving a clear. So this zone can actually be a pure consolidation within this time frame. Then the whole of this can also be consolidation within this time frame, depending on how you're looking at it. The whole of this can be consolidation within this. So it depends on how you're looking at it and what you are trading. So all these things you can see price from here, price get to this place, get back to this place, get back to this place, get back to this place, not moving out of this trap. It's like a trap on a particular range. So that's it. It looks boring, right? It makes your trading not interesting. It looks boring, and its price goes up a bit down. Both sides sideways are just stuck. So why does this happen? That's the question. Why does consolidation happen? Then we can actually say that the institutions are accumulating or that they are distributing position quietly. When these things are happen, either they are getting out of their position or they are trying to get more of a position, as in putting things in place for them to take a move. So either they are accumulating, getting more, buying or selling more, or they are exiting the one they are already in quietly. They don't want to push it so hard because that would be like shooting themselves in the leg. So you can see it price consolidate and then price are shooting up. So all this area, something is happening. To us, the market is boring, but to them, something is happening, is needed. But the retail traders, so for us retail traders, we get frustrated and often lose money trying to understand what is happening or whether to continue in the trade we are in or to close the trade that we are in or to enter a new trade is more like confusing for the retail trader when all these things are happening. You move through your chart, you see a lot of them. They are there. Look at this. This is consolidation. It can be little, it can be much, depending on the eye you're seeing them, but they are always there in your chart. They are always there. You see them everywhere, every time, all time frames, high time frame, low time frame. Look at it. You see price consolidating, a move, consolidating, a move, consolidating, a move. So they are always there. Then the next thing you can ask yourself, what is non-displacement? Like we said, this one is within a range moving. So suddenly price displayed, moved. Price in a range and suddenly the price moved. So they are always there in your charts. Price consolidated, then price displayed. So that's it. It's like the opposite is a strong, a fast, impulsive move in one direction. Look at it. Price break out of the range it has created, which look at it, price has been consolidated and suddenly broke out of that range with a big candle and momentum. This is how institutions actually move the market in their direction, right? So that having been said, what consolidation is, what displacement is, and let's start. The main thing you can ask yourself those questions, like if you understand what consolidation is, what displacement is, then you begin to understand how to trade them. So let's look at it this way, or let's start this way. That's like a pre-introduction of what we are talking about. So one of the biggest mistake traders or new traders make is believing that every market move is a trading opportunity. No, that's not. Every move is not a trading opportunity. You can see them consolidating. This whole range can be consolidation. This little one can be consolidation and then displacement. You can get a trade here depending on the time frame you're trading. You can consider the whole of this as your consolidation depending on the time frame. So you have to understand how to use them. So every movement is not a trading or a tradable movement. Um, so in reality, the market spend most of its time preparing to move. This is market preparing its time, itself. They are doing something. They are accumulating the market. And it depends on the time frame also. As in it depends on the section of the market also. So markets spend its time most of the times preparing itself for the actual movement. So this is where understanding the difference between consolidation and displacement becomes a game changer. If you understand this, what is the difference? How can you use them? How will it be of help to you? It will become a game changer for you. If you can identify when institutions are preparing for a move, which is consolidation. That's when they are preparing, gathering, accumulating. If you can understand it, then and when they are already committed to one, your trading becomes much more intentional, not you reacting to every move. Look at this, you can get a trade here. So you understand this, know when they are accumulating and when they are ready in a move. It helps you to relax and just wait for the market to do its thing. Do you understand? So that's it. You can see all these happening. So what's our learning objective? Why are we doing this? By the end of this, like we said, you'll be able to understand what consolidation is, what displacement is, why institutions use both consolidation and displacement, and how to avoid trading during low probability conditions. Then how to recognize when every move has begun. So these are the things we want to look into in this. So that having been said, like we said, what is actually consolidation? Just trying to get it sink into you. This is a period where price moves side by side. We can look at this whole area as consolidation, price moving side by side. From here, we can say price is moving side by side, not giving a real direction. So that's it. Instead of making a strong, maybe higher high or a strong lower lows, price stays within a relatively small range. You can say it. All this can be depending on how you're looking at it. You can also look at it just within this place. Sorry, you can also look at it just within here. Maybe you can say this within this level. You can take the whole of this range. So price is moving side by side. There is no clear range of what price is doing. Um, think of it like market taking a pause. Market is just trying to relax. Let's give this time. When we give instances, it helps. Imagine you have maybe like a shop in a particular area, and you know your shop is not always busy at some point in time. There are times that when everywhere is quiet, right? Like nothing is happening. Does not mean you're probably not gonna sell for the day, but because it's not just the time. You know the rush hour, you know the quiet hour, maybe students they've gone to school, people have already gone to work, probably during the break time you start getting a lot of people, or towards the evening time, you start getting a lot of people. There is a rush hour, you're trying to meet up, everybody's hand is on the decks. They start the same way the market. Market has a time, it pause, trying to gather itself, and something is happening. So even in your shop, when you're quiet, does not mean you're not doing anything. Maybe at the back end, a lot of work has been going on, preparing for that rush hour, right? The same thing. So that's exactly what market does. Okay, let's take another example. We are now in a World Cup season, right? And we have two teams playing, and suddenly they've started. We know this particular team A is playing team B, and one is on the right hand, one is on the left hand, and they are the boys in the middle of the field waiting for the referee to blow the whistle and before the game starts. So everybody knows that you don't know who is gonna win, which is like the retail traders. You are there in the pitch or watching on your TV, you have what you support. Like you believe in a particular section of the market, like probably I'm in for buying or I'm in for selling. So I'm supporting the team A, I'm supporting the team B. Those are the things, but you are waiting patiently to see exactly what is going to happen. But no team is going to play the ball until the referee blows. So this is exactly what it takes. We have consolidation, market moving, it goes up, it goes down. So you don't really know who or where the market is going, but you have something you're waiting for to give you a clue. So that's just it. That's what constantly we've given you an example of what to look out for. So no team is actually attacking anyone. Everybody's simple in their position. The selling is not going on, the buying is not going on. That's it. Everything is just maybe up, down, up, down. So what does consolidation looks like? We've seen this picture. That's why we wanted to make those more like in a chart classroom today. Seeing this picture, the question is, what does consolidation look like? You can see mostly small candles, slow movements, price movements. You can see the candles are not as encouraging. Even if we expand this, it's not as encouraging. And then the movement, look at it. We have from here is a lot of consolidation here. So small candles, slow price movements, DIX, check the time DIX has taken. You don't really know where you are. So multiple touches of the same height or the same lows. There's no clear trend. You can say price get up, touch this level, down, touch this level, back to this level, continue down this level, and then this level again, going back to DIX. So we are just in the same range. You can see it, even if we expanded DIX to here, you can see it. So there's no clear, whatever, clear direction of that. That's what consolidation looks like. Price appears to be stuck or caged in a particular cycle. So many new traders or beginners, they are impatient because probably they said, okay, trading is like every day making money. It was not like that. So they started forcing the trade because they think something has to happen. If the market is not moving, you move the markets. But that's not how it works, right? It doesn't work that way. It doesn't work that way. But the professional or the institutional traders, they know that patience is often the best trade. You know? Yeah, sometimes doing nothing is the best thing to do because you're not losing money. Yeah, you can only watch and say, okay, this is where I would have entered a trade. This is where I would have exited the trade. Okay, thank God I did not join this trade. Oh, I wish I joined the trade. But sometimes not trading is the best thing that has happened to you. So the professional, they are patient, they are waiting, and they are okay with waiting, knowing that the good trade will come. So the next question is, so why do institutions like consolidation? Why do they like things choppy sideways? Why are they, yeah, why do they like it? So like we often say that institutions, they don't randomly buy, they don't randomly sell, and there is a reason for that. They need time to build a large position. They need it. So if the bank they wants to buy something huge, they want to buy contracts, they can't simple press one button, sell. No. They can't simple press one button, buy. No. Doing so meaning that they will shoot themselves in the leg. It means that they will move the market against themselves. So instead, they gradually, like we said in the beginning, accumulate, they gradually distribute. Like we said, we have the accumulation phase, we have the distribution phase. So this is them accumulating gradually position or exiting, as in exiting the price, the ones they are already in. Either they're accumulating or they are trying to exit the one, buying new ones, or going off from the one they're already in. So either they are accumulating or they are distributing position while price is moving sideways. That's what they do with ticks. So we said consolidation provides the perfect environment for them to do this when the market is quiet. When the market is so quiet, it provides them with the best environment to do this. It also encourages retail traders to keep buying or keep selling within the range, thereby creating more liquidity. The market need liquidity to run. You can see, imagine someone bought this and suddenly price came back, took out everything and continue. Or if someone, you sold this and somehow price came back to calibrating and continue. So you see, it gives them the perfect environment to create what they want, liquidity. They are creating liquidity. So that's what consolidation does in the markets, is like the engine or what the fuel that the institutional needs. So think of consolidation like someone stretching before the sprint starts, before he start running or doing whatever. You see them stretching their legs, doing some things before running at full speed. They stretched and get into position. So stretching isn't the race. It's just like your body movement. That's what it takes. It's like preparation. Okay, trying to tell yourself it's time for us to get ready to run. So consolidation is the market stretching itself, trying to prepare itself before the real move is. So now the question is, what is displacement? We've covered consolidation in detail with examples. As you can see, this is a pure chart showing us a lot of them. Going through the chart, in all the charts, you can open any chart of your choice, any time frame of your choice. You see all these things playing out hugely, playing out. So displacement is like an aggressive movement away from an area. Let's take an example. Remember, we are just in the same charts and it's everywhere. Imagine this is price has been consolidating. Sorry, this is price. It has been consolidating for a while. This is it. And suddenly, this huge candle, the market displays moved away from that level. That's it. It's an aggressive move away from that level. Let's take a look at another place and see if we can see price doing the same thing. It can be small, it can be huge. Okay, even this. Let's take an example at this one. It's everywhere. It's everywhere. Market has been consolidating within this range. I did not cherry pick this, remember? Or even we move it to this place being fair. And suddenly price displayed away from that area. You can see like a huge movement from that. If you drop to a lower time frame, you see how huge this move away is. So it's everywhere in your chart, but just that we choose not to see it, right? So it's the moment institution reviews their intention. It's like an intention they've reviewed. Okay, we want to drop this. You see, price suddenly move away with strength and conviction. So instead of a slow candle that we've been seeing, you see this powerful move momentum. You see it instead of the slow, we've seen how and share the difference between dates, even where the same place that we showed a little example here. You can't compare these moves with what has been happening here. You see? So this is often where trend begins. Do you see how that has come together? Price was consolidating and suddenly there is a huge, look at this, consolidating and suddenly we have this movement. These are what we are talking about, okay? So the question now is, what are the things to look out for displacement? What are the characteristics of displacement? How will you know what a displacement is? Now, one of the things you should know is that it's often usually include a large candles. If you take this area, you can see it often includes a large candle. Look at this level. So often includes a large candle. Like we said, look at these areas, price moving. Then there is a strong momentum. There is kind of break of important structure. When that happened, look at this film. It broke out this, but the question is the structure an important one? So as we said, without displacement, it's just difficult to know whether move is genuine or it's just market noise. You need displacement to know like it's act like a confirmation. If there is no displacement, it's difficult for you to know as a new trader if the move is real or not. So displacement is like it provides confirmation of actually if what you are waiting for is real or not. Let's give a simple example. Imagine price has been moving sideways for several hours or minutes, just like it has been doing. Look at this area. Price has been moving sideways, and many traders become maybe like frustrated, and then suddenly the price sweep the range, which it can be low or high, or let's find a particular example of that. Okay, maybe look at this area. The market has been ranging here, and suddenly the market sweep that this range high. You can say it is sweep the range high, and after that the market expanded to the downside. You can say it with several large bearish candle. 1, 2, 3, 4, 5. You can say it. It's displayed. What happened? The liquidity above has been taken. You can see within this range, the market has been ranging and suddenly liquidity was, market took out this liquidity within this range. That's it. And dropped down, displayed on the downside, and then return back and continue to go down. That's liquidity has been swept, institution enter into the market, displacement confirm that they are in that market. It's like a confirmation of where they are going. So if you go through your chart, if you're in this chart, depending on the time frame you are, like I always said, until market gets to a particular level, that shows that trend has ended. So it got to this level and it shows there's reason for this level. It shows that okay, we are almost done, and then the market consolidates again in that the same level, and suddenly it displayed a way, broke out the structure like we've given that you have to see like a structure being taken when we are talking about the characteristics. You took out this major, this is a structure. Look at it. It came back, giving an entry and started to move up. It has shown its trend again. It intends to go up. It has been going up then. So it just depends on you to understand this. After the consolidation here, also look at it. Market was consolidating. Here it came down, took out a liquidity here, displayed up, which we also mentioned as one of the characteristics, and price started to move up because it has reached a particular destination. We have 4 cycles in trading. We have the market consolidating, we have the expansion, we have the retracement, and then we have the reversal. So you can see market just did that. It consolidated, it expanded, yes, it retraces, and then it started to reverse, started the cycle all over again. I'm just trying to take my time to explain these things in a way that anybody can understand. So what we've talked about consolidation versus displacement. So we said consolidation, we are looking at for what? Sideways movement. We are looking at for small candles. We are looking at for little or no momentum at all. We are looking at for liquidity sweeps, liquidity building and sweeping it. Then institution preparation. There is no clear direction, whether the market will continue to go down or to continue to go up. Then we talked about displacement. We said in displacement, we are looking out for a strong directional move. You can see this. We're looking out for large candles. You can see this, or you can see it here, whichever one you're looking at for. We are looking at for liquidity. The question, has liquidity to be taken? Has liquidity? You can see it here. It took out liquidity. We can see it here. It took out liquidity. Then institution commits, which is displacement and clear direction. So we said preparation is like, consolidation is like preparation. Why the displacement is like execution is started to happen. I didn't say it for you to execute, but it has given you an idea of what the market is about to do. So one of the biggest mistake we retail traders, when I said retail, we are looking at all of us, but the only way to differentiate yourself is buying into the idea or aligning yourself with the wisdom of the institutional traders. Is that retail traders often do the opposite of what they should. They trade inside the range, not patient enough, because probably they are bored or because they're in front of a screen, trading screen. So they wish they just have to be in the market. They trade inside the consolidation, which they should not. Then when displacement finally happened, they hesitate because the move looks too big. What am I going to do? Do you understand? In a normal circumstances, if this has happened and market retrace here, you'd have joined this trade. But trade has already reached, this is a topic for another time, has already reached a destination. So that's it. So they are like hesitating. What am I going to do? Because the move is huge. But professionals do the opposite. They remain patient during this consolidation time. Then they become interested only after displacement has shown them confirmation. Yes, I know some people can trade liquidity. Then even if you drop to a lower time frame, you will see there is a confirmation after this liquidity have been swept. If you move to like 1 minute time frame, 2 minute time frame, you will see the market also. That's just to go into your chart to find out the market after taking out this liquidity. You drop to a lower time frame, you'll see the market displaying away from this level, giving an entry, confirming it for those who trade a more smaller time frame. It's always there looking at you. So now, for us, the liquidity narrative, how do we or how does displacement fit into our liquidity narrative, our storytelling liquidity narrative? Yes, like I said, our liquidity narrative, displacement is never viewed in isolation. We are not just watching out for displacement. We're not just watching out for any consolidation. No, the real thing you should ask yourself, where was the liquidity? Like whenever we are doing analysis, we always said, where is the liquidity? So the question is, where was the liquidity? That liquidity, has it been taken first? Those are the things you ask yourself as the consolidation build or as displacement has been seen. Ask yourself the question, where was the liquidity? Has it been taken? Was there any displacement after the display? Like I said, drop to a lower time frame. I don't want to make this video so huge. If you drop to the 1 minute time frame, check out this level and see what happens. The liquid, has it been taken? Has it been, so did the market change structure? Okay, let's see if we can apparently do this. Which date is? I don't want to take this so long. Just go into your chart, look at this. That's for you to do. Has it been taken? Did the market change structure after this? Like we said in this particular time frame, look at it. Market came back after consolidation. Liquidity has been taken. There's a market structure shift. And then what happened again? It created imbalances, which is this level. Market retraces back into it and started to move. That's like you ask yourself, is there now an opportunity to join the move on a retracement? If there is an opportunity, you go into the trade. So you notice that displacement is not the entry. No, it's not the entry in some ways because the market has already moved. You want the market to get back to you at a discount for you to be a part of it. It's like a confirmation that the market has reversed its intention. I don't know if you grab that. I wish and I believe you understand because you have an understanding spirit. So I want you to do this. Open any chart of your choice. Find an area where price has been moving in sideways, any time frame of your choice for your study's sake. Go through any time frame of your choice, 15 minutes, 1 day, weekly, 1 month. So find an area where price has been moving sideways, just like we did here for a while, depending on your time frame, and then identify the highs and the lows of those range and ask yourself where liquidity was likely resting because liquidity will always be on those highs and the lows. Then observe this price sweep one side of those range liquidity. Was there a strong displacement that follows after that? The price later retraces before continuation. That's it. Just like we've explained here, this is it. Price has been consolidating within side ranges, and suddenly price came down, took out one side of that liquidity running, then price displays to the upside, then price retraces back into its place after. Repeat this exercise on a different chart. Try it in different charts of your choice. You will begin to see the same story over and over again. That's why we say the market is always telling a story. It is your duty to listen and understand the story that the market is telling you. So we said, try this, open your chart, go through it, do all that we say you should do. That's how to study, that's how to learn. Collect this information to your own advantage. So we say consolidation is the market. We are just trying to summarize it. Is the market preparation, is preparing the market. Displacement is the market delivering, giving you a clue what to do. Consolidation builds liquidity. It's building liquidity. We said that's where accumulation is being done. Displacement is like consuming, it consumes the liquidity. When it happens, it takes away those liquidities. In consolidation, it creates uncertainty. You are not sure whether this trend is going to continue unless you've already studied and know that price has reached to its limit. You are not sure. So it creates uncertainty. Displacement reviews institutional intent. It reviews, it tips. Like we said, you always leave a footprint in the chart. It is your duty to see where those footprints are. So it's like an intent, they leave an intent in the chart for you. So as a trader, our job is not to gaze when price will move. Like I may not know that price is going to move in this particular, but I know this area is an area of interest for me. So as a trader, you are not to gaze when price will move. Your job as a trader is to wait until the market tells us its story. tells us, okay, I'm about to move. Sometimes you might not see it coming, but oftentimes you will see that story being told. So our job is to wait until the market tells us its story. Patience during consolidations matters when the market is doing nothing. Then it can confirm as as a learner or a beginner for you through displacement. You can see all these things. Go through your chart. They are there. So the confirmations comes like after the displacement. That's how you begin trading with the market instead of chasing the markets. That's how you begin to see clearer in the market instead of taking irrational decisions or jumping because someone sent you a signal and said buy. You don't even know the reason why the person said buy. You don't even know the reason why the person said sell. You don't know the time frame the person is trading on. You don't know how much money the person is using. You don't even know how true the thing is. So instead of you chasing price, you begin to trade and understand the markets. So do not mistake the preparation for an opportunity. All you have to do is to wait for liquidity to be taken, wait for displacement in your starting points to confirm for you the market intent. Then trade with the narrative. Do not trade against the narrative. Trade with the structure, trade with the narrative in mind. Follow all this. Will you mix a trade? Yes, you will. With some trade go into stop loss? Yes, it will. That's why we said it's a probability business. The good thing is that you are in a higher probability to win than losing. So when you do all these things, you will understand and you'll begin to see that the story that the market is telling you, then your trade will be with a narrative, not against it. And that's why we always tell you, learn to map liquidity first. I don't know if this video has been insightful to you. Do subscribe, do comment, do let me know what you want us to do, and always follow up step by step what we are teaching. Map your liquidity first. Choose structure and not speculations. Learn to fish and stop asking for fish. That's us today until I come your way once again next week. This is Liquidity Narrative, and thank you for being here. Trade safe.